one analyst says expected V-shaped recovery. That's according to Morgan Stanley. The firm's chief U.S. equity strategist, Mike Wilson, wrote, "We remain firmly in the V camp because, like a unicorn, U-shaped recoveries coming out of a recession don't exist, particularly when the recession is so steep like the one we are experiencing today." Mike joins me now. Mike, I have to say my daughter was not thrilled about the unicorns don't exist comment that I said, but putting that aside, walk me through your rationale for a V-shape, where it's really hard for me to find anyone who can substantiate that from the data.
Yeah, I mean, part of this is just the simple math of it, right? I mean, clearly when you have the kind of decline that we're seeing, the rate of change is going to appear to be a V, even if we have a relapse later. So first of all, let's talk about the alphabet soup that we're in right now. We think an L is off the table, right? Because of the stimulus that's being implemented, it's unlikely that there's not going to be a flat recovery and kind of a depression outcome. So that's off the table, we think. That leaves you with kind of three choices, right? A V, a U, and a W, okay? Well, first of all, a V and a U look like a W until you get the relapse. And so we're going to get a recovery, and we think it's going to look steeper than what people are sort of, fretting over. And the fact that, the intro to the show shows that most people are in that camp probably tells you that the opportunity to bet on a V is still available, and that's our call.
Well, that's an interesting take. I wonder when you're looking at the data, is it the rate of change or the levels that you're paying closer attention to?
Well, it's both. I mean, for now, it's rate of change because you're starting from such a low level, and that's what the market's focused on. That's why the rally has been so steep, because the market is anticipating a sharp recovery. Now we're getting into the tougher part of the equation, which is, okay, well, great, we're having a recovery. We know that. But how far can the recovery actually go, and can it be sustainable? Look, we don't know the answer to that. Nobody does. But history would suggest that we have probably at least 12 to 18 months of runway before we have to worry about that relapse.
Meaning that even if the levels are still low, the rate of change will actually stop being so dramatic, and therefore that is a more positive indicator of V-shape?
Well, the reality is because we're from starting such a low level, you have a long way to go before you even have to worry about getting back to where we were, right? So we think we could get the economy in the U.S. back to where we were by the fourth quarter of 2021. All right, so that's a lot faster than what happened during the Great Financial Crisis, but it's still a long way away, right? In other words, we have a huge hole to fill from this recession for the next 6 quarters before we even get back to where we were. And that process is what the market's trying to digest now and trying to figure out, okay, well, how fast does it take us to get there? And then what does it look like from that point? That's going to be a question, I think, for later. Right now, because the rate of change is so steep, the market's looking forward and betting on, revisions are bottoming and estimates are going to have to start coming up again in the back half of this year.
So then how do you play it from a long to medium term to short term basis? Because we've heard from a lot of heavyweights. I mentioned it earlier, David Tepper, Bill Miller, Druckenmiller, just the idea that we're so overvalued. They're much more pessimistic on the economy. But then on the flip side, if what you're saying is right, if you don't bet on cyclicals now, you're going to be missing out on the opportunity to do that when we start to enter the V-shape.
Yeah, I mean, I think it's a little bit ironic to say, the market is so overvalued today, but wasn't overvalued in December or January, right? So we didn't hear a lot of folks talking about that. But we were at the time saying we thought the market was overvalued. And the difference between, say, December and January is that obviously we're in a recession now. Back then we were not. But we also have, $4 trillion of fiscal stimulus staring at us, okay? And I think the chance of us getting that back in December or January was zero. Obviously, we didn't have a recession, but also politically it would be difficult to imagine. So, because this is a health crisis, because, there's no governor on what we can do from a fiscal and monetary standpoint, if you think about it that way, we actually have more growth impetus in front of us for the next 12 to 18 months because of this stimulus. And I think that makes it actually the market look a little bit cheaper today from our standpoint than it did back in actually December and January. And what we measure that is, well, rates are lower, okay? The stimulus is enormous, and the equity risk premium you're getting paid is higher than it was at that time. So, I could argue the market's cheaper today than it was in December or January, but that's not consensus. That's not the consensus view.
So let's separate two sectors, one the growth and one sort of the cyclical, and that's banks and tech. So on the one hand, tech obviously outperformed, particularly the big guys, but you can make the argument that they actually sell the stuff to the players that are getting hit, that sell stuff to consumers. So that's one. On the flip side, banks just really have gotten decimated, particularly as Randy Quarles was like, maybe we need them to have more reserves so they can lend more. How do you think about those two?
So, from our standpoint, as we exited last year, we thought the barbell that made sense was to be long quality and defensive securities in the equity market, and that's a classic late cycle playbook. Now, all we're saying is, look, quality is always a good place to be. Quality stocks tend to work, but now what we want to do is we want to shy away from those defensive areas and move more towards cyclicals. And because we're in a recession, that's what you're supposed to do. Last recession, or the recession we're in now, rather, the last expansion, the excesses were concentrated more in the corporate sector and corporate credit in particular. The consumer sector actually remained under-levered, and so we think that the rebound will be more centered on the consumer cyclicals as opposed to the CapEx beneficiaries, and that would include some of the hardest hit areas, right? Now, banks is an interesting part of that as well. Clearly, rates are really, really low, and that's what's weighing on the bank stocks right now. We think the curve will steepen. The question is, how much can it really steepen if the Fed's buying as much as they're buying? We think one of the bigger surprises could be that the yield curve actually steepens more as the market starts to look out to 2021 and it sees a real GDP, resurgence from the rebound that we're getting. And if that happens, then that's when the bank stocks can actually start to work, and that could happen over the course of the next 3 to 6 months.
Mike, good to catch up with you as always. Mike Wilson of Morgan Stanley.